Welcome to a video that I like to call the deep dive video. Please don't let this name mislead you. I do a number of videos every week. I do daily videos, I do a weekly video, I do an intermarket analysis video. At the end, the final video that I do each week is I go back and I look through all of the daily charts and I say, I didn't really talk about this chart this week, or I only showed this chart one or two times. And so I put this together, going through some charts that I didn't show all that much, just to see if we can get some insight and some clarity as to what's happening in the market. The first thing that we look at is a thing called the VIX and a ratio of the 3-month average of the VIX. What I mainly look at is the red line. That's a moving average of the ratio, where we continue to go down, which is also what we're seeing with the VIX, that fear is really non-existent right now. We also look at another chart of the VIX where I plot an RSI 9 period. We look for extreme positive or negative readings. We are declining here, but we're not getting any extreme readings, so I haven't been showing that. Then I also look at a ratio of the VIX to the VIX of the VIX, or the VVIX, and I plot a moving average down below. The more this declines, the more positive that is. You can see when we topped out here in late 2022, this has been coming down overall, and the moving average has also been coming down overall. This suggests that fear has been decreasing, and that tends to be more favorable for the market. Then I look at a long-term moving average of the VIX. The VIX is on here, but I've turned it invisible. And then I place a 50-period exponential moving average on here. We typically use static numbers with the VIX, roughly 12 to 12.5 on the downside and 20 on the upside. Well, the VIX is its own thing, and it moves in a range. From 2008, 2009, it got up to about the 40 range, down to about 20. Then it shifted down from 2012 to 2020. Then after the whole COVID plunge, it shifted back up, and now we're starting to see it drop down below 20. So we can just keep a more dynamic view of the VIX while also keeping in mind the static numbers that most of the market uses. Then we look at a one-day chart of the equity put-call ratio. The reason why I don't show this very often is this is the last thing to update every day. A lot of times when I'm getting ready to do that daily video, this chart hasn't updated yet. I don't know if it's information from the CBOE, which is where this comes from, or not. But this is also showing that we're dropping down as the market has been going up. That means people are doing less hedging on their positions. We also look at a 5-period simple moving average of the equity put-call ratio, which is also declining. What I typically show in each day's video is a longer-term version of this chart with different areas pointed out so we can look for signals that may be helping to tell us what's happening with the market. We also want to keep track of where are we from the all-time high. We set the all-time high back in early January 2022, and we've come back up quite a ways since then, and we're currently down 6.5%. Then we also spent a lot of time around the 4,000 level. We're getting far above that now. We got above 4,500 this past week, but we spent a lot of time bouncing up and down and up and down, so I just kind of think this is an interesting chart. Technical alerts are put out by stockcharts.com. You don't have to be a member to go and look at these. They're put out every day. This is just for a Friday session. We read these from the bottom up, where right after the open on Friday, the S&P 500 set a 52-week high. So did the NASDAQ. The euro against the dollar set a 52-week high. When they're blue like this, that means they're positive. When they're red, like the dollar set a new 52-week low near the close of the market, that is a negative sign. We also look at 5 different indexes. We look at the Dow, the S&P, which is the main index that I focus on, the NASDAQ 100, the mid caps, and the small caps. StockCharts.com also has a ranking system from 0 to 100. The higher the number, the better the score. It's purely objective. They're just taking technical scores, and the higher the score is for that chart, the more positive it looks technically. Coming in first place again this week are the QQQs, which is the NASDAQ 100, and it comes in at 98.2. In second place is the S&P 500. There are a lot of NASDAQ 100 stocks in the S&P 500, and that's been helping to bolster this average overall, and this score is 87.4. We look at the mid caps in third place at 65.7. Then the small caps in fourth place at 58.2. And what's been lagging behind right now is the Dow with a score of 44.1. Now, we look at some short-term charts as well. This is a short-term rainbow going from 10 periods up to 50 periods. We're well above all of the lines in this moving average rainbow, and we're starting to see the lines flatten out a bit. That means that we're in a good, solid uptrend. Then we also want to see how far are we away from the 20-period simple or exponential moving average. We came down when we saw some weakness a few days ago, and this actually acted as support, and we've been bouncing up off of that. Since we're far away from that moving average right now, I haven't been showing it. This is a similar chart where I take a 20-period simple moving average of the open, high, low, and close. This also acted as support when we were running into some difficulties, but we've now been able to bounce above that. Some fundamentals just to keep up with where we're at. This is earnings. Now these are historical earnings looking back where they're pretty much flat overall. As the S&P goes up, the earnings haven't necessarily come out to justify that, and so the PE ratio ends up going up as well. We're at 25.72. That's above that 20 static level. And as the PE ratio goes up, the yield goes down. This is the dividends that are coming in from the S&P 500. We look at some intermediate term charts. This is the Connors RSI. We use it the same way we do a regular RSI. We look for extreme positive or negative readings. It's kind of hard to get some divergences from this because this moves pretty quickly. But typically if we're above the dashed line, that's positive. We're dropping below it now, so that's slightly negative. We also look at the 50-period moving average, and we're quite a ways away from both the simple and exponential moving averages, so I haven't been showing this chart. And the same thing is true with the 100-period moving average. We have an intermediate term rainbow going from 50 periods up to 100. We're well above all of the moving averages, and this is also starting to smooth out. We look at a 50-day cycle, which for the last year or so, that seems to be pretty helpful to us. The last time we hit a cycle was on May 19th. We're coming up to another date on August 1st. Now, if you look back, 50 periods each time here, sometimes this marked a low, sometimes it marked a top, other times the market just kept going and didn't even seem to notice this. It's just one of the tools that we like to look at, especially when we're getting near or at a cycle date. Then we look at standard deviation. How far are we above or below the standard deviation price going back 10 periods? You could also say that's the average price. When we're below the moving average, that means we're below it, and we're not showing a lot of movement right now. The Pring bottom fissure, since we drop below the red line, it is not generating a signal. And then we're far away from this anchored moving average going back to the all-time high, so I haven't been showing this chart. We're well above the 200-day simple moving average, so we're green. And the mass index is not generating a signal right now. We only pay attention to this when we get to the red dashed line or the blue line. Since we're far away, we're not really paying attention to it. This is another chart that I constantly refer to in every day's video. What this chart does is it looks at the two bottoms that we made in June and October of 2022 and then draws a trend line between them. And then on top of this is a parallel line going back to the all-time high. When we were coming up in the middle to late part of May and into June, it looked like this was going to provide some pretty significant overhead resistance. Well, we did. We came up, we bounced back, we came up, we bounced back. Well, then we were able to break through that. And we're far away from this trend line now, so I haven't been showing it in the videos. We look at the Ichimoku cloud. When we're above this and dropping, it acts as support. When we're below it and going up, it can act as resistance. And we're far above the cloud right now, so I haven't been showing it. All this really is a set of moving averages that are set forward from that time. And a lot of people use these as signals. We haven't seen any changes on the point and figure chart. We still have our last signal that was generated on May 18th. That was a double top breakout. We haven't seen any new X's or O's being added as of late. Longer term charts. This is a long-term rainbow going from 50 periods up to 250 periods. We're again well above all of the moving averages and the lines are smoothing out, suggesting a good solid uptrend. This is a chart that I like to use every day, but lately the S&P and the 2-year yield have been going in the same direction. Now, in Thursday and Friday's session last week, we saw a real reversal where the 2-year yield was really going down, where the S&P went up on Thursday and then went down a little bit on Friday. We're going to see, is this spike going to come down? Because sometimes when we spike up and then start dropping, oftentimes that will give short to intermediate term support to the S&P. But since they were going in the same direction, we weren't really getting anything from this chart. We look at different support and resistance areas. These are quadrant lines, and we're pretty much in no man's land right now, so I haven't been showing that. The same thing is true with our short-term fib chart. We've retraced all the way back to the previous high, and now we're coming up well above that, so it really isn't telling us anything. Our longer-term fib chart, if we keep going up, we'll go back to the all-time high. If we start to fall, then we'll be looking at this as potential support. The same thing is true with our longer-term fib chart. We actually have two Fibonacci lines on top of each other here. We're far away from those retracement levels. The next area up would be the all-time high. If we fall, we'll be looking for this as support. The broad market, this is the Vixen, which is the VIX for the NASDAQ 100. I don't really pay attention to the top chart because there's a lot of erroneous data. I look mostly at the line chart below, which is also confirming what we're seeing with the VIX, that there's not a lot of fear in the market. Then we compare the S&P 100, which are the biggest stocks that make up the S&P 500. For a while last spring, they were diverging from each other, where the S&P 100 was going higher as the S&P 500 was going sideways. They're moving more in lockstep with each other now. We also keep an eye on the micro caps, the really small stocks. When I really pay attention to this is when we drop below 100. We did earlier, and we set a new 52-week low. Now we're at 110, so we're comfortably away from that level. We also look at a weekly chart of the QQQs with an anchored moving average going back to the all-time high. We're well above that now, so there's been no need to show that. We're also keeping an eye on the financial sector, where way back in 2007, we hit a high here and then spent a lot of time underneath that level. It acted as resistance before. Well, during 2021, we broke through that. What was once resistance now becomes support, so we've been coming down, and so far we've been hanging out above this level. We're kind of far away from it now, but if we start to fall, we'll come back and look at this chart. Rate of change charts. These go back 250 periods, showing that we are seeing some improvement in this chart. Going back all the way to 1980, we're also seeing some improvement there. This is a chart that shows the euro dollar, which is in red. Those are dollars outside of the US. That acts as a good proxy for the Fed funds rate. We compare that to the 2-year yield, and they tend to move in tandem with each other, but we really don't get an awful lot from this chart other than seeing what the short-term trend might be. We also keep an eye on the yield curves. All of the yield curves that we follow remain inverted as of now. We kept an eye on the 1-month, the 3-month yield, where the red line should be on top, the green line should be on bottom. For a while, they were getting kind of out of sorts there because of the debt ceiling crisis. Once that got solved, things have gone back to normal. We're also keeping an eye on the S&P 500 against the long-term bond ETF. Usually, they have a tendency to go in the same direction over a long period of time. We've seen that really fall off as of late. In a shorter time frame, they are starting to go more in the same direction. But when we compare the difference between the two, the spread is still really wide. So we're just keeping an eye on this chart. We also look at the US 10-year yield and subtract the German 10-year yield, and that gives us this line that we have up here. And wouldn't you know, it really correlates pretty strongly to the US dollar index. Now, the correlation has fallen off a little bit lately, but there are times when these have a tendency to go in the same direction. An update of some of our possible positive scenarios. I usually only show this chart when we're showing an extreme reading. These are the S&P 500 stocks above their 50-period moving average. When we get above 90, that's an extreme positive reading. When we get below 10, that's a negative reading. When we're above 50 and advancing, that's generally a positive slant. So we are seeing some improvement in this chart. Then we look at the mid caps, which are also showing some improvement, and then the small caps as well. And then this is the percent of stocks in the S&P 500 that are above their 200-day simple moving average. Also, we use this like an oscillator. When we get an extreme positive or negative reading, we're above 50 and advancing, so that is positive. Then this chart's been kind of coming in and out, but it's changing so quickly. This is a 19-day exponential moving average of the advanced decline ratio of the S&P 500. We're above 0 and advancing, so that's positive for both price and volume. We tend to use this like an oscillator when we get an extreme positive or negative reading on either one of these. And since we can use both price and volume, we can use them to confirm each other. Thank you. I hope you found this helpful. Please feel free to check out some of the other videos that I post. Have a great weekend, and I will talk to you in the next video.